So what are the keys to being a successful options trader? Today I want to cover some of the basic rules, some of the basic guidelines that I think we all must follow in order to become a consistently profitable options trader. So trading options, what works and what doesn't? So let's talk about the keys to being a successful options trader. So very first thing we need to talk about is you want to put on high probability trades and you want trades that have a positive expectancy, meaning high probability means you're going to win on most of your trades, and positive expectancy means if you do these trades enough over and over and over again, you should come out ahead in the long run. We also must focus on being consistent with our sizing and our risk. So when we're talking about consistency with sizing, we're talking about our position sizing, and with risk, we're talking about how much risk we're taking on each trade. We must be consistent in sizing and risk. We also need to make sure that we're trading the proper strategies for the current market conditions, because certain strategies work better under certain conditions and other strategies work better in other conditions. I think we all can understand that. A few other things we need to consider: we must consider liquidity, we must consider the effects of time, and we must consider all possible outcomes before we enter the trade. So let's take each one of these 6 bullet points and discuss them in a little greater detail. First, let's talk about putting on high probability trades and having trades that have a positive expectancy. So high probability, we want to win on most of our trades. For me, when I'm selling options, for example, I like selling, for example, 20 delta puts. A 20 delta put tends to win about 80% of the time, and I like that. I like winning on 80% of my trades. You know, would I want to instead be on the opposite end of that trade and, only win 20% of the time and lose 80% of the time? No, it makes your life a lot easier as a trader if you win on most of your trades, because if you're winning on most of your trades, there's less for you to do. There's less headaches to manage. And then positive expectancy, you want to trade strategies that you know are going to be winners in the long run, as long as you trade enough occurrences of them. For example, I know that SPY, the S&P 500 ETF, the SPY, right? The SPY tends to just go up over time. There's a positive drift to it. So I know most bullish strategies are going to have a positive expectancy on SPY. They should win in the long run, as long as I trade enough occurrences. Now you have to trade enough occurrences of anything for your positive expectancy to actually play out, because of the law of large numbers. We've stated this many times. If you trade just a few occurrences, well, you could be lucky. You could be really lucky and win on every trade you make, or you could be really unlucky and lose on every trade you make. But if you make hundreds of trades or even thousands of trades, if you have that many occurrences, then your actual win rate will match your expected win rate. So you have to trade enough occurrences for the probabilities to eventually play out. So when you find a strategy that you think has an edge and should work out for you in the long run, you have to do it as many times as you can. You have to trade small and you have to trade often. You have to get as many occurrences, thousands and thousands of occurrences over the lifetime of your career as a trader. You got to get as many of these occurrences in as you possibly can. Some other things you need to be mindful of. You need to be mindful of IV, which is implied volatility, because the higher the implied volatility, the richer the premiums are. If you're selling options, for example, you really want to sell options when IVR is very high. Now, when IVR is very low, the premiums are going to be cheap, and that's typically when you probably want to be buying options rather than selling options. You also need to be mindful of delta and how it affects your probability of profit. So we already stated earlier, when I sell a 20 delta put, I know I have a win rate of about 80%. I know my probability of profit, my pop, is about 80% on a 20 delta short put. But if I sold a 40 delta put instead, now my pop is only around 60%. So I've lowered my probability of profit. So just be careful. Just know that delta has a correlation with your probability of profit, and just be consistent. If you have a certain kind of probability of profit, a percentage that you want to win on each and every trade, then be consistent with that and be consistent with the deltas you choose when you put on your trades. So let's talk about consistency with sizing and risk. So you want to be consistent with your sizing. You want to make sure that you have a certain percentage or a certain dollar amount in mind every time you place a trade, a certain amount of money you're willing to put up as risk on each trade. And you want to make sure that you never trade too big. The key to success here is to stay small and never trade too big. You never want to have too much of your money at risk in any one trade. You also never want to have too much of your money at risk in your overall portfolio. So one of the things I often see newer traders do is they will be really inconsistent with the size of their trades. They'll put on a whole bunch of really small trades where they're only risking about 1% of their total account in each trade. And then all of a sudden they'll take a trade where they risk 10%, 12%, 15% of their entire account in one trade. Now, when you do that, you're setting yourself up for failure, because risking an unusually large amount of money on one trade can wipe out so many of your smaller gains that you may have made along the way, because that one trade was just too big, and then you got unlucky on that one trade and you just wiped out weeks or sometimes months of gains by just being inconsistent with your sizing. And you also want to be careful about risking too much of your total net liquidity account value at risk at any one time. You don't want to be using too much of your buying power at any one time. So as a general rule, I really think you should stay under 50% of your total buying power in use. If you start getting above 50% of total buying power in use, that's a danger area, because especially once you get to 60%, 70%, 80% of your buying power in use, all it takes is one crazy event like a market crash or a volatility spike, and there you go. You just blew up your account because you just had too much of your money tied up in all these trades at one time. You always want to have some cash on the side. So for me, I don't like ever having more than 50% of my account in use at one time. Another part of being consistent as far as the risk you take, you don't need to trade just one strategy or trade just one underlying. That's very, very dangerous. You must be diversified. You need to be trading multiple strategies, have different strategies, some defined risk strategies, some undefined risk strategies, have some bullish strategies, have some bearish strategies, maybe throw in some neutral strategies as well, and never trade just one product. Don't trade just the SPY or just the ES. That's dangerous because, again, in a market crash, for example, where SPY or the ES all of a sudden crashes 30%, well, if all of your positions were tied up into this one product that is suffering a severe crash, that's a bad day. And finally, talking about consistency with risk, when you put on a trade, obviously you put on a trade, it has a certain amount of risk to it, right? You're putting up a certain amount of buying power, for example, for this trade. So you can consider that the risk you're putting on the trade. But later, the trade may go against you. You start losing on the trade. And some people will then all of a sudden start adding to the position. They start adding risk to the trade, essentially. Never add risk to a losing trade. So let's talk about proper strategies for current market conditions. So when you're trading options on stocks, individual companies, you need to ask yourself, are there earnings coming out soon? So if I'm putting on a trade that is 60 DTE, and the stock has earnings coming out in 15 days, I know that chances are I'm going to be in those options positions through the earnings event. And do I want to do that? Maybe, maybe not. That's something I have to consider. Also, you have to consider just the broader macroeconomics of the market. You need to think about, hey, are any major economic reports on the calendar? So is PPI or CPI or PCE or the gross domestic product, initial jobless claims, any of those major economic reports, are they being reported, for example, this morning that I'm trading? I need to be aware of that, because if there is some report coming out today that could move the market in a major way up or down, I may or may not want to be putting on a whole lot of risk by taking on a whole lot of new positions today. Obviously, you have to consider geopolitical news. You You have to consider, are there any potential wars that are about to be started in certain areas of the world, especially in parts of the world that produce a lot of oil, for example. You have to consider political elections. We've been dealing with a lot with elections here this year because obviously the US elections are coming up in November, and in Europe we've had some recent major elections that could shake up the market a little bit. And then you need to also consider the underlying product that you're trading. Are we at any kind of extremes? Are we at an extreme in pricing? Are we at a very high level or a very low level, especially say over the last year for this product? Are we at an extreme with implied volatility? Is implied volatility through the roof, or is implied volatility very low right now? Because when things are at a very high or low extreme, then you may or may not want to play certain strategies. Let's talk about liquidity, because one of the rules with trading options especially is you must consider liquidity. So with options, you want to look at stock volume, you want to look at option volume, and you want to look at open interest on the underlying. If I switch over to my trading platform, let's go to TASTYTRADE, and let me just pick a stock. I'll pick Dell, for example, here. Let me go to the options chain. So if I want to determine if Dell is a liquid product, first I check the stock volume. I can see that 33 million shares were traded on the last trading session. That is a pretty good number. That is a hint that Dell is a very liquid stock. If I go to the options chain, I'll go to the monthly options chain, and I can check stock volume and or open interest. I've got open interest on this column right now. And I can see there are thousands of open contracts on pretty much every strike here in the monthly options chain. So in my opinion, Dell does meet the criteria of being a liquid stock. Now, another thing to consider is that some option cycles are more liquid than others. So when it comes to liquidity, this monthly option cycle that we were taking a look at here in Dell is very liquid. I would have no trouble getting in and out of any option I buy or sell in this options chain. But if I go to the weekly cycle, maybe the 41 DTE weekly cycle, and look at open interest, remember we had thousands and thousands of contracts open on each strike in the monthly cycle. But look at the weekly cycle. Open interest is essentially zero on each and every strike. Nobody's trading this thing. The bid-ask spread is $2 wide on some of these puts and calls. So this is a very illiquid option cycle. I would not trade this 41 DTE cycle. This is a death trap because you're just giving up way too much money on your entries and exits because the bid-ask spread is just too wide. But that monthly cycle, the bid-ask spread was only 20 to 30 cents on a stock that's $115. So it's much tighter. And again, we had much more open interest. So I'm much more able to get in and out of my trades, and not only just get in and out of my trades, I'm going to get in and out of my trades at better prices by picking the option cycle that has better liquidity. Also, you might need to take a look at each individual strike as far as volume and open interest, because some strikes will have more open interest than others, so certain strikes will have more liquidity than others. Another thing to consider is earnings, because some stocks will be very liquid around their earnings event because a lot of people are interested and excited. A lot of people are trading that particular stock because of the earnings. But once the earnings is out, then all of a sudden liquidity sometimes will dry up. It'll just completely disappear in some stocks. So let's talk about the effects of time, because you really have to consider the effects of time when you're trading options. First of all, you need to make sure that you're always on the right side of time. You have to be on the right side of theta. And how do you do that? Well, you make sure that you're selling options rather than buying them, because when you sell options, you benefit from theta, you benefit from the passage of time. When you buy options, you're actually punished by the passage of time. You actually lose money each and every day due to the passage of time. Also, when you're selling options, you have to be careful and not go too far out in time, because some people will sell options at 90 DTE, 120 DTE, 180 DTE, and that's just too far out in time. That actually is hurting your profitability a little bit, because theta really doesn't start ramping up until you get to around the 60 DTE mark. So when you're selling your options, try to sell your options around the 45 to 60 DTE mark. That has been shown as being optimal. TASTYTRADE has done research on this, and they like that 45 to 60 DTE mark as far as an opening trade for selling options, because that's when theta really starts working for you. If you go really far out in time, theta is very low. So those longer time frames, they really decrease your return on capital because that theta decay out really far in time, that theta decay is much less. And of course, that's with selling options. Now, sometimes you may want to buy an option. There's nothing wrong with occasionally buying options, and kind of the reverse of when you're selling options. When you're buying options, it's actually better to go further out in time because, again, that low theta, right? Theta punishes long options. So obviously, when you buy options, it's best to go further out in time. So that is when you probably want to go 120, 180 days out, or maybe even a year out, because theta is so low out that far that it's really not punishing that long option all that much. And the last category we should break down, you want to consider all possible outcomes before you enter a trade. So when I place my options trades, there are really two questions that I immediately ask myself as far as the possible outcomes of this trade, as far as managing risk. First, I ask myself, what if this underlying stock rises or falls by 25 to 30% tomorrow? What if I wake up tomorrow and this underlying stock has dropped 30% and I'm in a bullish position? How bad will that hurt me? And will that hurt me enough to really damage my account, or will I be okay with it? Would I survive that event? If the answer is yes, I might put on the trade. If the answer is no, I definitely will not put on the trade. The second question I ask, and it's equally as important, is implied volatility. What if IV increases by 25 or 30% tomorrow? Because I'm typically selling options, and an IV spike, an IV increase is extremely damaging to short options. So I imagine, hey, what if I wake up tomorrow and IV has exploded by 30% on the underlying stock that I'm trading? Will that damage me in a major way? Would I survive that event? If the answer is yes, I may or may not place the trade, but if the answer is no, I definitely will not place that trade. Some other questions you may or may not need to ask depending on the type of underlying products you trade. You may want to ask about the CEO. What if the CEO dies tomorrow? You know, the CEO of certain companies. Some CEOs are more important than others. There are some CEOs of major companies that are very public, very outspoken, and they are very much the company, right? It's much more about that man or that woman in some cases than the company itself, right? That is mainly people are buying and selling the CEO, right? They're trading the CEO rather than the company itself. So what if that CEO suddenly dies? I'm thinking of obviously when Steve Jobs died, you know, the CEO of Apple at the time, and, you know, that caused a major crash in Apple at the time because people were worried about the future of Apple. I could see a similar thing happening to the companies that Elon Musk is CEO of, because Elon Musk is such a big part of things like Tesla, for example. I could also see the same thing happening with a stock like DJT, which DJT is not a real company necessarily. It's all about people buying shares of DJT because they support the campaign, the presidential campaign of Donald Trump. And obviously that particular stock is very interesting because it really is all about one person. It's about Donald Trump. Well, Donald Trump is an 80-year-old man. What if he passes away tomorrow, right? Would you want to be holding shares of DJT? Would you want to have a whole lot of money tied up in a lot of risky options positions in DJT? Now, again, you have to think about these things, and you have to make sure that you're managing your risk accordingly. You also have to consider things like certain industries or certain sectors. For example, if you do a lot of pharmaceutical stocks and biotech, well, what if the next drug trial that they're doing, what if that drug trial fails? What will that do to the stock price? Sometimes you'll trade companies and there'll be rumors of things like a merger or a buyout or a hostile takeover, whatever it happens, whatever news is out there, you have to consider, okay, what if this rumor actually happens? How will that affect my positions? So there you have it. I know we covered a lot of stuff on this particular slideshow. Obviously, you know, the keys to successful options trading. There's so many things that need to be considered before and after you place each and every options trade. And it can seem overwhelming when you're a new options trader, but the more experience you get, the more trades you make, the more a lot of this stuff just becomes second nature. Now, if you want to learn more about options trading, and specifically my favorite option strategy, which is the wheel strategy, check out my book, The Super Wheel Option Strategy. It's available on Amazon. You'll find a link in the description below. Also, if you want to help support my work, please consider subscribing to the DT Options Discord channel. I hold a live voice chat there in the Discord channel every trading day. We start at 8:15 Central Time, 15 minutes before the stock market opens. opens, and we typically go for about an hour each trading day. You'll find a link to the Discord server in the description below. I'd appreciate it if you sign up. I'd love to have you there. Peace, guys.